All right. So this is episode 2 in our mortgage process series. We talked about the pre-approval process, but now we're going to talk about what happens once you have an accepted offer and you have your purchase contract in hand. And that's going to bring us to the loan estimate. So once you have your purchase contract, you'll bring in that back to your mortgage advisor, and they're going to give you a loan estimate. The loan estimate is going to be just that, an estimate of the loan, and then it'll also include some disclosures in a packet, usually about 40 to 50 pages. But that can really vary depending on how many borrowers you have on the loan and then the loan product itself. So the first page of the loan estimate is going to be a breakdown of your loan itself. Those details will include the loan amount, the purchase price. It'll also include the rate and your monthly payment. So your monthly payment itself is going to consist of your principal and interest always, and then it could also include your property taxes and your homeowner's insurance if you decide to escrow those into your monthly payment. Sometimes it's required, sometimes it's up to you. I usually suggest just escrowing that. So once your property taxes are due, it's going to come out of the escrow account and not have to come out of your pocket. It's usually a good lump sum. So after the loan details page, you're going to look at your closing costs. And the closing costs are going to include title fees, county fees, and then funds needed to fund your escrow account. So title fees will include a notary, for example, printing documents, and then the service they provide, and getting that information to the county so the county can put the title into your name. And as far as funding the escrow account goes, like I mentioned before, you'll pay into escrows each month. But for that first year, if you're paying each month, there may not be enough money in that escrow account to pay for your property taxes and your homeowner's insurance. So to avoid that, what's going to happen is you're going to fund your escrow account before. So once your property taxes and homeowner insurance come due, there's already enough funds in there, and you won't have to come up with anything out of pocket. So after the closing costs are covered, that's when you'll jump into your disclosures. A copy of your application is going to be in there, and that's where you just go through and verify that everything that you provided on your initial mortgage application is still correct and accurate. So yeah, that pretty much wraps up the loan estimate. The next step in our series is going to be underwriting. So yeah, go ahead and tune into that.